morning and welcome to BloombergQuint. I'm joined by Neelkanth Mishra of Credit Suisse this morning. Now, Neelkanth and his team have recently authored a very interesting report on unicorns in India. That's billion-dollar companies in India. And the report says that India has at least 100 unicorns, whereas other estimates out there in the market put that number at between 30 to 35. Together, these 100 unicorns in the Credit Suisse report are worth an estimated 240 billion in market cap. Now, while there are lots of numbers to dazzle in the report, and we'll get to that, the key message seems to be that India's corporate sector is maturing. We'll talk to Neelkanth about that and many other things. Good morning, Neelkanth. Thank you for your time this morning.
Thank you for having me.
Neelkanth, before we get to unicorns, let's talk bulls, bears, hawks, doves, and the rest of the zoo. I wanted to get your thoughts in on what we've seen in terms of volatility, not just across equity markets, but also bond markets. In the last couple of months, the fears around inflation, the standoffs in many countries between central banks and bond markets, the outflows that we've seen of foreign money from India, not very substantial, but small. But, can you share your views on where you think we're headed to here?
Yeah, so I think the first thing is that the recession last year was a very different type of recession. And I think most forecasters, struggled, and including us, have struggled to grasp the longer term implications of that, right? So what we saw was that if you think about CY21, in India's case would be like FY22 versus CY19, right, the pre-pandemic year, and you thought that CY20 didn't exist. How much lower should CY21 be? And I think there, just like in India's case, FY22 was it was cut so much that it went 2% below FY20. And now I think it's at +2. And I think it should be +7, +8. And I think that reset globally, the fact that this was not the Lehman bust, that this was just forcing people to stay behind, and then a lot of government fiscal stimulus coming through. So I think the growth rebound has been and is likely to be much faster than in earlier recessions, right? From the low levels. It may still be below where we would have been in the pre-pandemic path, but it will be faster. And I think what we have seen because of that is that bond yields have gone up. Now that's not surprising. Pre-pandemic 10-year bond yields in the US were at 2%. Now, if you cannot expect them to stay at 0.5 if the recovery is actually faster than what you're anticipated. When something like that changes that rapidly, it creates turbulence everywhere. Right, so there are fears, and at the same time, demand supply. Right, so if you have the industry as well, right, so the industry is not paid to forecast. Right, they are paid to produce oil, paid to produce aluminum and steel. Right, and their forecasting in many ways is no better or worse than that of the market forecasters. So we have been caught napping. The pace of the recovery turned out to be much faster, and therefore everything came into shortage. Now what you're seeing is that so for 2-3 months it seemed as if oil could not stop, that steel would not stop, iron ore was at 180, and this was the supply chain bullwhip that we kept talking about. This is not going to last, right? Because one, there was a services to goods transition during the pandemic. As the economies open up, there will be a switch back to services, and therefore the demand for goods is going to fall. Many of the other emerging markets, because this normalization happened and their external accounts had not balanced as much and they were not attracting as much capital, say Brazil, Turkey, Russia, they've all been forced to raise rates. So suddenly the tightening is starting much before the market anticipated it. The collective imposition of, or at least reprimands being delivered by the Western world, like the US, Europe, and China, has also created uncertainty around, as we must have seen, the Hong Kong market has been very weak. So this is now bringing in new types of uncertainty into the system, and which is a good thing. It's also part of the normalization process. It was because if oil was at 60, 65 before the pandemic, for it to be, unless you thought that a lot of capacity had been destroyed, for it to actually go to 75, 80 was unlikely, right? And this is why I have never been worried about inflation being sticky. I was worried that inflation will rise because of the supply chain bullwhip, but so I think we are seeing that adjustment. That is why this volatility is happening. People are now recalibrating that this growth to value switch, is it now overdone? the dollar weakness, which had become so consensus that I was worried that it would swing the other way. It has started to swing the other way. The dollar is actually strengthened. And this is expected to be shorter term because the US somehow seems to be addicted to fiscal deficits now. And so removing that addiction or reducing that addiction is perhaps the next step, but we'll have to see that. So there are, I think, uncertainties. That's why there is a market. But so this volatility is, I think, an adjustment process, right? So the straight line recovery that people expected is no longer going to be straight line. Central banks will take decisions. Government geopolitics will keep changing, and now you have to start pricing that in.
Okay, you used a word that I wanted to use as well, which is adjustment, right? It seems to be like the markets are adjusting, like you said, with the pace of recovery. One quick follow-up question specific to India. I think in India, what we've been seeing play out in the bond market is more to do with, the borrowing program. I don't know whether inflation expectations are very sticky here. How do you view that? How do you view very quickly the small amounts of foreign outflows that we've seen here in India? And also, Neelkanth, let's not forget, we do seem to be in what looks like the second or third wave, depending on how you count it, in terms of increasing number of cases. Now, very different from last year because there are no overall lockdowns, shutdowns, and things like that. But does that change your estimation of the pace of the recovery?
Actually, you answered the question that the impact of the pandemic. I mean, and I do not want to dismiss the risks from a very sharp surge, right? I mean, so we must have seen the Punjab study yesterday that 80% of the cases were the UK variant, which spreads very rapidly. It is not more virulent in the sense that it doesn't, the fatality rates are not higher, but the pace at which it spreads, it actually puts pressure and perhaps ends up killing more people. So this is not just another flu, but at the same time, the fact is that most of the vulnerable people have been vaccinated. The super spreaders in, say, public officials, essential workers, medical staff, they have been vaccinated. The case fatality rate even now is 0.5%, despite the number of deaths picking up. And infection fatality rate. Now, the infection to case ratio, which was at 25-30 times earlier, based on seroprevalence studies, because the identified cases are a fraction of the total cases, right? Because there are so many asymptomatic infections. So that may be even 10. I mean, I would say that may have fallen because the testing is still at 1 million a day. But even if it is 10 times, right? So infection to case ratio is 10. So the infection fatality rate is still 0.05%. So for the right reasons, I think administrators are going to be a lot more careful about imposing activity restrictions because the cost of that has been seen. And as many administrators have said that, the first lockdown was essential because they didn't know what we were dealing with. Now we kind of know what we're dealing with, and there are some tools available to us, which is why the 45 plus, and I'm very excited now, has been opened up for vaccination. Yeah. So we are disclosing our ages now. So the point is that this is so the economic impact of that, and in fact the people's reaction to that. Like, look at rural areas, right? I mean, in my village, people now yawn when you tell them about COVID, right? So the point is, the economic response comes from either administrative controls or people's fear. Both, I think, are now much lower, and therefore, it can perhaps, if that 108 that I was talking about, that if FY22 in real terms was 100, FY20 was 100, we 108. Maybe it's 107.5 now or 107, right? But it is still far higher than what consensus is at, and what I think market is pricing in. So I'm quite okay with that. There was the question on the Indian bond market. Now, I think
bond and equities, I think, because I think a lot of viewers will want to know what your outlook is from here on.
Sure. So on the bonds, I must say that reading too much from the Indian bond market is unwise because it is a very distorted market. There is a structural shortage of bond demand. So I've been saying this now, and it makes me a bit unpopular with the bond traders. But the point is, the bond price setting is actually done by people who hold less than 1% of outstanding bonds, right? So the most vocal ones are the private bank treasury guys and the mutual fund guys. And naturally, the bond buyers will have a bias for higher yields. It's a given. The problem has been that as you cut the SLR, right, over the last 15 years, there is no structural buyers that has actually, the structural buyer that has come in. So till the time that we get included in the bond indices, it is going to be like this. Because see, if you think about actual bond demand supply, this year, the government announced some 80,000 crores of extra borrowing, right? Yeah. Now you look at the corporate tax collection, the data that, some news reports talked about, that it's actually going to be 1 lakh crores more than what the government had put in the revised estimates. So that cancels it out, right? So no extra issuance of bonds. Are the yields going back to 5.9? They're not, because there is price setting happening. So taking too much of fundamental information from the Indian bond market is something that I would refrain from, because it is a lot more liquid than it used to be, but it is still not. There are not enough. There's not enough diversity of action. There's not enough diversity of analysis of perspectives that price that, and so therefore prices are not as informative as I would like them to be. So therefore, I don't want to read too much into that. On the equity side, see at a nifty level, so when we put out, I used to say in December in our outlook that we will expect double-digit returns. Those came by end of January. So after that, it's very hard to keep saying there are no more double-digit returns, right? So what we can advise is that I think the growth proxies, banks and industrials. So our advice is mostly on the sector preference. So it is more about banks and industrials than on just buying high-priced excessive PE stocks, which may not see that much of a growth surprise. So it's not a growth versus value thing that people like to simplify it to, because in industrials there are stocks valued at 60 times earnings that we are overweight on, right? Because that's where the earnings can surprise positively.
Okay, that gives me an overview. Let's get to your famous unicorns report right now. My first question really has to do with 100 unicorns, and I went through the names. And here's what I found, Neelkanth, and I want you to explain this to us, right? In that list, whilst there are lots of new companies, let's say like Flipkart or PhonePe, there are a ton of old companies as well, almost 20. Garda Chemicals, 1967, Serum Institute, 1996, Parley Products, 1929. These are the years the companies were founded in. Haldiram's, 1937, Piramal Glass, Medha Servo Drives, Manipal Hospitals, 1953, GRT Jewelers, 1964. I could go on. National Stock Exchange, 1992. So is this just a nomenclature game? Like so far, unicorns were considered to be more recently founded companies. You've sort of widened the timeline, and therefore you have more companies on that list.
Great question. So, no, our objective was not to give a nice 100 number. In fact, as someone asked quite cynically, 100 is such a round number. So did you kind of bump it up or did you bring it down, right? So we had to cut it, right? Because we excluded. I will not name the companies because I don't think we can take company names. But there were 4 or 5 that we cut out because we weren't very convinced. And let's look at the objective of this report. Right? So the objective of this report is there enough risk capital in the economy? Are we, by just looking at the listed space, what are we missing out in terms of the prospects of the economy? So when we went about screening companies here, we did not want to limit ourselves to just the e-commerce and edutech and fintech companies, right? Because that's reasonably well known. Though of course they are very exciting things, and I would love to talk about them. But at the same time, India is not a 4-5% nominal GDP growth economy, right? So if you're in the US or in Europe, if you want fast-growing companies that are creating a lot of value and therefore wealth, those companies will will have to be in something which is massively disruptive. In India, we are seeing double-digit nominal GDP growth, right? So we didn't see that for the last 2 years, but I think we are going to go back to it, and these companies will contribute to that. Then, if you add to that formalization, if you add to that some product innovation, it is possible to grow at 18-20% a year for a sustained period, and therefore you can create a lot of wealth. So once you start screening like that, so what we did was we said, look, let's look at all the 50,000 unlisted companies for which we have data. Screen out companies which are at a certain EBITDA level, profit level, and also profit growth. And if it is not part of a multinational, so if it is a subsidiary of a multinational, remove it. If it is already part of a business group, remove it. Just look at independently funded companies and see how many there are. And so once you create the filter like that, you cannot exclude a company just because it was founded in 1929 or 1961. And some of the firms that you made have actually seen mergers in the recent past, and they're actually very attractive prospects for private equity firms. So many of these names that you mentioned have actually come from PE firms as well. That these are names that actually we are very excited about, and they can grow very well. So, but to put the facts in place, 2/3 of the companies in our list were founded after 2005. So even if you want to go by vintage, there is, and truth be told, we have discovered 12 to 15 more names, which people have sent to us. How did you miss this one? Right after we published the report. So there is the underlying message that there is a big change in wealth formation, in company formation, and in skilling up of companies is very much there. And if you see about why we think this is a virtuous cycle, right? So the fact that there is $35 to $50 billion of wealth created for the promoters of these firms suggests to me that a lot of this, and going by evidence as well, that a lot of this gets recycled, reinvested into new startups, right? So India, as a poor country, right, very low wealth per capita, very small percentage of wealth in financial assets, has actually not lacked entrepreneurship. It has lacked capital, right? And therefore, the fact that private equity has come in a big way, it is bigger than public equity. The wealth that this has been created by these companies, like one of the firms you mentioned, though it was formed a way back, it is now invested in an NBFC. Now the wealth created is what I am looking at, and that pools of risk capital can actually create a virtuous cycle. Many of the promoters of the unicorns that I know are actually very avid angel investors. So if you look at it from that prism, it is important to look at all companies irrespective of when they were founded.
I still feel a little cynical, and I would imagine some people might join me in that view that if it's taken you 20, 30 years to get to $1 billion valuation, I'm not sure what message it gives about the underlying economy. But your broader point taken, because like you said, 2/3 of the companies in your list were founded after 2005. And I think that's where I have a couple of quick follow-up questions. I think what your data suggests, Neelkanth, is that companies, especially these new ones founded after 2005, when compared to, let's say, those companies in the BSE 500 that have achieved a market capitalization of $1 billion or more, if you were compare the two sets, the newer companies are growing bigger, faster. And I think there are a ton of underlying reasons put in your report. Of course, the explosion in the internet, digitization, things that have happened over 20 years, road infrastructure, all of that. But if you were to identify one key attribute or one key reason for why we're seeing firms become bigger faster, would that only be capital?
That is the most important reason, because India is because risk capital, right? I mean, look at the extreme case. If you want to set up a steel mill today, you need to have at least a 4,000 cubic meter furnace. That means that you'll be producing 3 million tons of steel a year. That means you need to have infrastructure to move 4 million tons of material every year, right? 3 million in, and I would say 16 million or 12 million tons of material movement. How many people can afford to invest $3 billion? Right? How many business groups? And that's an extreme view, of course. But for any company to scale up, if the rich countries, the countries that are rich today, grew over 100 years, 200 years, right? 1.5% over 200 years. They're in economic history, their growth is measured on a decadal term. That there was a 10% growth this decade, there was a 18% growth this decade. India is trying to grow at 7 to 8%. That's the target anyway, or objective anyway. That every year, and I think you need a lot of risk capital that needs to go in, and that is, I think, the biggest enabler. But I think that the impact that roads and internet and data have created are, of course, are massive. I must say though, that some of these firms themselves are also public goods. So look at, the fintech model, right? So in fintech, if you are, what is the next big, and so as Ashish, my colleague Ashish put out this fantastic fintech report on how the account aggregator model, so we have moved beyond the Jam Trinity. So 6-7 years back, you were excited by that. We built UPI on top of that, and look at what that has done, how transformative it has been. Now all that data is going to be fed into digital lending, right? So earlier it was impossible to get loans, but now with all this data and the account aggregator model, so you can, a user can say, okay, yes, it is okay to share my bank account and transaction details with someone. And even the lending models have evolved, right? So you start with the 10,000, 20,000, 50,000 rupee loans. And as you see a good repayment cycle, you start bumping that up. So the algorithms have matured. So in the next 1 or 2 years, you could see a lot more small businesses. So the growth in the fintech unicorn space is also an enabler. Same with e-commerce, same with the new age distribution. Today, if I have a great idea for a product and a brand name, I don't need to worry about national distribution. I don't need to worry about the necessity of having national advertising. I can do very focused brand building. I can feed it into the modern trade and e-commerce channels and the new age distribution companies, and build a fairly decent brand. Same with education, right? So what I recently heard, and I'm very excited to see this happening so fast, is that just like I observed in, say, software as a service, that it is becoming harder and harder to isolate which country does this SaaS company belong to. So there are firms started in the US. I mean, there's some friends of mine who've done the same, who on day one have a development center in India. There are startups in SaaS that have started here where the promoters have moved to the US because it's easier to sell. Same in education, right? If the content for US educational standards can be created here, does it really matter whether it's an Indian company or a US company? And I think these are, so imagine if that kind of content is available to everyone in India, right? So these themselves are enablers of and they're solving very hard problems which have held India back.
Okay, so I think you explained, I mean, there are a couple of things you point out in your report, that this is the kind of growth we've seen over 2 decades. So people need to recognize that this 100 unicorn list did not happen overnight. Second, like you've pointed out in your responses as well, it's virtuous. And the third, therefore, you've explained why you think it's sustainable. One quick follow-up question on the sectors, and I don't want to get into it in specific detail, but you have pointed out in the report that the kind of funding that industrials is getting, at least in terms of number of deals, has declined quite substantially. What does this say to quality of growth? Because eventually large-scale employment, etc., would come from firms of this nature, right? So I'm just concerned on whether you think that feeds into your broader narrative of the kind of sustainability this has and how it would feed into GDP growth.
Yeah, so when you think about funding cycles and think about how emerging nations in the past have grown, right? So when the US was an emerging market in the 19th century, it grew from capital inflows from Europe, right? So UK, France, Netherlands, Belgium, these were the rich countries at that time. And the US and Latin America actually were considered at par. Now, it was mostly in the form of debt because equity had not emerged as that easy an option at that time. And there used to be bad debt cycles, right? So every 7 to 10 years, there would be a bust and then a shakeout. And then 3-4 years later, again, someone would start, because the fundamentals were there. In the same way, in India as well, the private equity infusion will have volatility. So 2015 was when everyone was getting funded. 2017 was drought, right? So, but the longer term trend, because the path is there, the people are there, the education is there, and some hard problems of just connecting people are getting solved. So I think the trend line is what we need to focus on. There will be booms and busts, right? So one large firm throwing money into the Indian market because they made some excess money in some listing of a Chinese e-commerce company, he actually had created a lot of funding boom. And when they stopped funding, then there was a bust. But but it is the long-term trend line. And in fact, while I have the last few minutes, let me also address the concern that you raised earlier, that if the company has taken 70 years to become a unicorn, why talk about them at all? We did put a screen of growth in the last 5 years.
Okay.
Right. So you may have been formed 80 years back, but maybe your grandson or great grandson has now transformed the company.
Really got it right.
Yes, and used the right opportunity, or maybe the enablers have allowed that innovation to work, and therefore, look at some of the vaccine biotech companies, right? I mean, their growth has been absolutely phenomenal. You can't say that, you were started as a horse breeding company and what have you achieved? They've achieved a lot.
Look, there's a fairly good mix of companies in your 100 unicorn list, but industrials is definitely smaller. So I was just curious to know whether that concerns you with regards to
no. One of the things that we did do, and perhaps that's our own bias, is that we kind of excluded construction companies. So there are several construction companies which are larger than some of the listed construction companies which are in the private space. But it's very hard to get a firm view without knowing in detail and all that. So we kind of excluded them.
You don't want to end up with egg on your face given that sector. So I imagine that's where the concern lies. Look, I know we're short on time. You have a bunch of back-to-back interviews. So I'll ask you one final question. You've raised the issue of, not the issue rather, but you made the point of how private capital has far outdone public market fundraising over the last several years, right? It's almost twice as much if you look at the trend line over the last few years. And most of it so far has been foreign. I'm just curious, there's an opportunity here, and maybe we're not at that stage, as you've pointed out in the report as well, in terms of per capita wealth and how much we own as Indians in financial assets. But there is a market here, an opportunity here for regulators to rethink how we look at some sophisticated products, to be able to channel more domestic savings towards this boom that's not just foreign capital driven, right?
Yes. So, and I think those changes are now starting to happen. So, because now there are pools of capital which are wanting to chase that, right? So the fact is, if you have a founder of a $1 billion company, by the time it gets into the Series E, Series C, Series D, or even IPO, the stake left with them is only about 15-20%, maybe less, right? And if there are 2-3 founders, but they will have $50 million, right? Now, $50 million you can't put into an FMP or a money market fund, right? So. And many of them will want to be exposed because they have seen that. So unlike a traditional dynastic business where they would set up a new division and say, okay, now we are investing here and this is what my cousin is going to handle. In this case, there's no cousin in the big business group. And, so there is, and you have seen how much wealth can be created by the right idea. So you're very eager to actually fund those businesses. So that is starting to happen. In fact, now recently, one organization raised a 1,000 crore fund, purely domestic private equity. So it is starting to change. Of course, in the next 4-5 years, as the exits start happening, I think you will see more of this. But also remember that just like that fund I talked about, where one large IPO of a Chinese e-commerce company and a lot of capital got recycled. The PE firms that are making wealth, creating wealth out of these startups, as they start seeing exits, guess where they're going to put the money? Right. So I think we are reaching a very exciting phase, and I think the impact of on incremental GDP is actually quite meaningful as well. And we talk about that. Right? In the next 5 years, the incremental revenues from these firms could be 5% of incremental GDP. Right. So they're starting to, and the enablers that they are. So I think that's the biggest takeaway. People have asked me as a public markets advisor, why are you bothered about these firms?
Yeah, because the public markets also, I think, in some ways feeling left out of this entire private fundraising exercise,
correct.
Right?
Right, and that's why I think SPACs are emerging. If you see some of the people behind SPAC, I mean, we had a wonderful session at our Asian Investor Conference by some of the leading lights of the SPAC world. And they said, look, the number of listed companies in the US has collapsed. So there is very small amount of money, and it is very hard, and a lot of the activity had moved to the private space. So SPACs had to come in so that you get, at least from the investor side, there are advantages for the companies that they highlighted, but from the investor side, the willingness to and the ability to partner with some of the growth happening. So yes, I think that this is not the end of the story. This is actually a very exciting phase of the story in the next 3 to 5 years.
Yeah, I think that's what was most interesting about the report, that it gets you thinking, right, about where this can take you, where the opportunities lie, and where possibly some of the risks lie as well.
Yes.
We're at the end of our time, I know. So thanks very much for joining us this morning and talking us through this. Like I said, great report. So thank you for that as well.
Thank you. Thank you, Menaka. Thank you for having me. Great.
Thanks, Neelkanth.